beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Taiwanese index, though, is a bit of an underperformer, down around about 1.75%. The Hang Seng continuing its outperformance from where it left off.
Gross fixed capital formation, which has been the engine of growth for the past 3 years, has clearly slowed to 5.7%.
So recent data points in the US, high-frequency data points, have all been pointing to a little bit of slowdown. About 0.4% higher on the Nifty, 22,200. The Nifty Bank is down about 1%.
Based on some of the patterns, at least another 3 quarters of negative movement. That's very much there.
Because we are closer to the bottom. Now, whether it is 1,000 points away, 500 points, I have no idea.
SIP flows could be substantially higher than where they were a year back.
What costs about $6, $5 per 1,000 tablets could potentially cost about $35 to $40 out there.
And the advance decline ratio, despite the recovery, continues to favor that of the decline. So
Well, there was green, then there was red, then there was green again, and I think there is a little bit of green now. That's essentially the story of the market so far today. This is Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Reema here in the studios, and Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi, good afternoon, folks. I guess, we can always crib and cry and say that we've underperformed the global recovery because global markets have done much better. But I think this is still okay, given the morning sell-off. I mean, from that point onwards, at least we've got some green back on the screen.
Well, that's right. And at least for today's trading session, the 22,000 mark has got defended, right? It was looking quite bleak in the initial hours of trade. And someone would tell you that 60 minutes left to trade and you will be in the green with close to 750 stocks advancing. I think you would have taken it early today. So let's see whether or not we can build in from here on and end maybe probably at these levels a little bit higher towards the end of the session, guys.
Actually, that advance decline chart basically is instructive because at one point it was almost four stocks down for one up. It was 500 up and 2,000 down. That number is now 850 up and about 2,000 down. So it's caught up. The gap has narrowed a little bit, although in the broader market, I think there is still pain. But 22,000 holding on for now. And that's some kind of reprieve. So small mercies, but that's essentially what it's been like for the last several weeks now. Every day there's been some days, of course, been slam dunk. Other days it's been less severe, but broadly it's been on the way down. So a flat day and off the day's low, I think, is welcome relief. The sensex is up on your screen. Let's just look at the mid and small cap indices. Maybe there, as the advanced decline indicates, the pressure is a bit more. At one point, down 2%. There also there is sharp recoveries. The small cap index is down 0.5%, and the mid cap index actually is up in the green. So very, very smart recoveries coming through across the board. Reema.
Well, there are two problem stocks which are dragging the frontline indices. One is Reliance Industries. That's down nearly 2.5%. And Reliance Industries is now down nearly 30% from its 52-week high. So Reliance Industries now at 1172. And the other one is HDFC Bank, which is down close to about 1.7%. In fact, the picture, except HDFC Bank and even Axis Bank, is a little bit in the red, but the rest of the private financials are holding up in the green. So whether it's an ICICI Bank or even a Kotak Mahindra Bank. In autos, stocks are reacting to the two-wheeler sales numbers. So you've got TVS Motors, top of the charts, 4% up. Eicher Motors is higher on the way down, though you've got Bajaj Auto, Hero MotoCorp, where you can see an adverse reaction. And Coal India is the biggest loser today on the Nifty.
Yeah, I mean, and Coal India actually is interesting because some of the other PSUs are actually seeing a recovery. Coal India has individual company-specific issues that it's perhaps tackling. But otherwise, if you look at some other capital goods stocks, the PSU stocks, then there is a bit of an increase. The PSE index is also reflecting that. The CPSE index has moved in positive territory. So examples would be a BEL. BEL is seeing a nice surge now, almost 5% higher on BEL. There are the power financiers, and we'll tell you more about them. There are some positive brokerage notes that came in on PFC and REC. And those stocks have been holding up as well. In general, capital goods is getting a bit of an upward bid now. So BEL we mentioned on the defense side and the capex side. Look at a BHEL. Look at something like a Tata Power, which is now up about 2%. throw in some more names. Even Siemens, Siemens is quite visible on the gainers list now, 4% higher. ABB India is 4% higher. Cummins is 4% higher. So capital goods, industrials, that's where there's some bottom fishing going on, both on the PSU side as well as the private side. Nigel.
Okay, all right. Well, let's get in Mitesh Thakkar to help us out with what's the trade. Mitesh, we went down to around the 22,000 odd mark. We bounced a little bit from there. I think earlier this morning you had mentioned the 22,300 or thereabouts. That's going to be the next level of resistance. Trade on the Nifty. And what about the Nifty Bank? Surprised to see the weakness out there because the last few trading sessions, that was showing a relative outperformance. But today, clearly, that as well has given in. Your take?
So, Nigel, I think, we've kind of recovered from the lows, but the key index which I was watching was the Bank Nifty. I think a close below 48,000 will trigger some kind of negative movement because if you look at the closing of 13th of January, which was an important low, that was 48,041. So taking the options strike also in some put option consolidation at 48,000, I think that's the level to watch out for. The Bank Nifty did decline below that, but has recovered. And the Nifty also recovered from lower levels. But again, there's no big sign of reversal, which means that you might see the Nifty, some bounce back because of short covering, but unless until we see some kind of a strong reversal pattern, I would be inclined to go long on the Nifty, and I believe that around 22,400, 450, which is where yesterday's high were, you will see a lot of supply emerge. So nothing much on the indices, but on the stock side, I have two buy calls. PFC and REC both are on the buy list. PFC is a buy with a stop below 373 for targets of 395, and REC, that's a buy as well. Keep a stop below levels of 371 here, 370 half year, and look for a target of around 400 on the upside.
Okay, in fact, PFC and REC, Mitesh, have also made it to CLSA's high conviction, stock. So they've got CLSA as an outperform rating on PFC and REC after the 35-40% fall from its 52-week highs. Pharma is now joining in with the details.
An interesting commentary coming in from CLSA on both PFC and REC. Both of them now are part of the brokerage's high conviction outperform stocks list. But interestingly, the price target for both of them have been cut by CLSA. For PFC, it's cut to 525 from 540 earlier. For REC, it's also cut to 525, but that was from an earlier recommendation of 590 rupees. Now, what CLSA is saying for PFC is that the existing pipeline of undisbursed loans will support the double-digit growth prospects that the company has. And the ghost of their past of bad loans is almost behind, and the outlook on future disbursals is positive as well for PFC. It also called the best delivery on loan growth, ROEs, and a dividend yield, along with attractive valuations, is what prompted CLSA to put PFC in the list of high conviction outperform names. For REC as well, the 55% undisbursed sanctions are already signaling a double-digit growth for the company. It's not seen slippages in almost 3 years now, and the outlook on the new loans is also positive, and it has a best-in-class delivery and a strong senior management record. Interestingly, both PFC and REC is tracked by 12 analysts each, and all 12 of them have a buy recommendation on the stock. So both of them doing well in today's trading session, and despite the price target cuts, a potential upside of almost 45%.
Thank you very much for that. All 12 analysts tracking the stocks are bullish on PFC REC. Dipan Mehta of Elixir Equities is now with us on the show. Dipan, are you also bullish? Stocks have fallen 35-40%.
Nerima, good afternoon and thank you for having me on your show. Yeah, of course, I am bullish. I think the biggest attraction in PFC and REC is the low valuation. They're going at around about 6 times average P multiple, which is quite attractive compared to any other NBFC or bank. Even on the PSU side, price to book, I think 1.2, 1.3. So definitely from that point of view, it's attractive. It's just that there's volatility in their earnings and you don't get that typical 15, 16% type of loan growth. But I guess, they should be getting there sooner or later. So very positive on both these companies. And in a situation where, you expect banks and NBFCs to outperform because of RBI action and the sector to do well, I think PFC, REC can certainly recover the lost ground which they have, as we have seen over the past few months or so.
Okay, so PFC, REC definitely getting the benefit this afternoon. Dipan, if I go a little further and extrapolate that, good afternoon, by the way, if I extrapolate that to what we're seeing on some of these capital goods stocks, industrial stocks, where I was just pointing them out, ABB, Cummins, Siemens, all of them are up. Tata Power is seeing some gains as well on the power side. Is it too early to start bottom fishing, or are valuations now already looking good? Are you convinced about any of these stocks at these prices?
But also would be a very positive on entire capital goods space. You can add L&T also to that list. And the likes of ABB and Siemens, they've always been expensive. So that's why we avoided them. But nonetheless, I think they've delivered very good returns over the past 5-10 years or so. And we've seen a steep correction in both ABB, Siemens, and other related capital goods companies as well. So I think this is not a bad time for somebody looking for a safe, high-quality capital goods company. And what I like best about Siemens and ABB is that now I think finally they've found their space within the entire Indian ecosystem in terms of what products and services they're going to offer. And they're getting out of the commoditized businesses and focusing more on technology where they have an edge. And that means that earnings, I think, going forward should be pretty sustainable.
Let's talk about M&M, because Mahindra has overtaken Hyundai in the month of February to become the second largest car maker. And the stock is also holding up in the green. Very strong SUV sales numbers. Sudarshan joins in with the details.
So M&M has outperformed its peers, and it's both the segments, auto as well as tractor. Sales for both these segments have come in better than estimates. And auto segment was led by SUV, in which M&M continues to lead, and it's the leader. And SUV growth in February month was up 19% against total auto sales growth of 18%. Coming to tractor segment too saw a healthy growth of 18%. Remember, on Friday, we saw GDP growth coming in, which one segment that has outperformed all the other segments was agriculture, for which GDP growth for Q2 has come in at 5.6%, much better than the estimates. So basically, it's boding well, and everyone has been talking about recovery in the rural demand, and that's one of the reasons that you have seen healthy growth for tractor, not only for M&M, even Escorts Kubota has reported a healthy growth for tractor segment, and that's the reason you are seeing a big move in M&M in today's trade.
All right. No, absolutely. It's 1.25%. I mean, of course, it's come off the highs of the day. Closed on Friday at 25.85, went up today to about 2,700, and it's given up about 100 rupees from the day's highest level at this point in time. I mean, it's an off-discussed name, Deepan, but do you have any thoughts, M&M?
Prashant, good afternoon. I think very good set of volume numbers coming through from M&M, and clearly they're gaining market share. All the new models which they have introduced last 2 years, extremely successful. And it's a company which is focused on its capital allocation, which is also very impressive. So we remain very positive on M&M, and this correction is a good opportunity for investors who are underweight auto sector or want to look at a good large cap stock with steady growth prospects to consider M&M. Having said that, it's a company in which we and our clients are invested in, so our views could be biased to that extent.
Okay, all right. Hi, Deepan. Good afternoon, Deepan. It's been one of the hottest ends of the year to February. Actually, hottest end is the month, and from here it's only going to get even hotter. A couple of stocks in focus could be some of these power generators, JSW Energy, because they have a lot of their power that they sell via the merchant route, so they could be potential beneficiaries. And it's so hot, the AC sales are likely to surge. Maybe that could be the reason why Voltas is higher. Anything you like from this space?
Yeah, Nigel, again, disclosure, we and our clients are invested. We like this air cooler company, Symphony. And although the December quarter numbers are not that great, but considering its position in the industry, considering that it is, all its products are exceptionally good, and they're getting into some of the newer categories as well, but that will take some time. But in a situation where aircon sales and there's so much of heat, this is one company which is available at reasonable valuations, and its market share and its dominance is pretty impressive. So very positive on Symphony, very light asset business model as well. And hopefully some positive news can come from its subsidiaries also.
Deepan, these broking companies, right? I'm sure you would have heard you read Nitin Kamat's tweet, talking about market volumes falling. Angel One is the biggest volume-led loser today. I mean, back at about 2,000 rupee levels. I saw BSE earlier as well, which is down to about 4,300, 4,350. Any thoughts here, Deepan?
No, Prashant. I think all these capital market related companies which are focusing a lot on transaction, they need to be avoided. That is exchanges and brokerages. But the wealth management businesses like say Nuvama, 360, I think if they correct further from these levels, they're quite interesting. The entire wealth management industry is focusing on trail commissions or kind of, a steady annuity type of business income. And with the way the prospects of the industry, I think those are great companies to own for the long term. They could deliver very good returns. And even Motilal Oswal, I think, is going more and more away from the transaction-related revenues, more into annuity-type businesses coming from portfolio management and mutual fund business. And it's really valued at very attractive valuations as well. So rather than going for companies which derive commission type of income, I would prefer companies where there is steady revenue growth and focus more on wealth management.
What about rate gain? We've spoken, Dipan, about rate gain in the past, and I know you were positively inclined. Now, the stock is practically halved. Its all-time high or 52-week high was 860. And stock is down about 45% from that level. And the company has been lowering its revenue guidance. I think it's happened twice in the last 6 months. Have you been buying rate gain in this correction?
No, Rima, but it's certainly on our watch list, and we're just waiting to understand exactly what the business dynamics are and why it is, the growth rates have come off, and whether that is kind of permanent or there are temporary kind of transient issues over here. But it's a very good company in terms of its platform, its services, and if you hold long enough and if you've got an attractive valuation, which it is trading at just now, I'm pretty certain it will be a great outperformer, especially since we're very positive on the travel and tourism space. And if you look at that entire spectrum, there are hardly any good stories to buy in the travel tourism space. I mean, you have the hotels and you have the airlines. But beyond that, I think, asset-light business, a platform business, I don't think there's any other kind of a similar company which investors can consider.
Okay. That's rate gain. By the way, a couple of interesting stocks on the move. Real estate stocks have seen a turnaround after the big drubbing they've got. Let's pull up AB Real Estate if we can. The stock opened about 6-7% lower in the morning. From there, there's been a steady pullback. Aditya Birla Real Estate, if we can get that up on the screen. Now days high, almost 10% higher. The other one is Prestige Estates. That's also seeing a bit of a bounce. So a couple of pockets in the market. One are the durable makers, the AC makers like Voltas, Blue Star, etc. The cooler makers, they're moving higher. Capital goods equipment makers are moving higher. And real estate seems to be seeing some sort of a relief or reprieve. Deepan, on real estate, what is the sense? Would you buy anything in this area right now? I don't know if you've looked at AB Real Estate or not, but anything here after the correction?
No, Surbi, I think that we are seeing a mild slowdown in real estate across the board. I think managements themselves, Godrej Properties themselves also said that there are some concerns. So I just want to wait and watch. I know long-term prospects are great for real estate and they are in a nice multi-year positive phase, but there could be a few air pockets, and I think next few quarters could be a bit challenging. So I just want to wait and watch and maybe wait for further discount to the net asset values for these companies in order to justify buying. So let's just, you remain invested in these companies because they're given great returns and long-term prospects are good. But from a tactical short to medium term point of view, I would just stay wait and watch.
Realty is one of the indices that's fallen close to about 25% since the beginning of the year and 30% plus from its 52-week high. But thank you very much, Dipan, for joining in. We'll slip into a very short break. But as we do that, let's listen in to Ramdev Agrawal. We had a conversation with him on whether we are close to the bottom. Is the sell-off ending? Listen in to what he had to say.
Earnings profile is slowed down, but it is not broken. I mean, last year, the current year, the earnings are going to grow at about 5-6%. And there is obvious reason for credit slowdown, economic slowdown. Every aspect of tightening by the regulators have happened. And now, there was the election, so there's a delay in the government expenditure and all. So all of this have passed. I mean, this is the year of actually all kinds of difficulties, I would say, in economy. So I think we have set the mood. One, correction is done. The P multiple, which was at 23, 24, that has come down to less than 20. And it is at below 10 years average. So I think it is painful, I understand. It is painful to me also. But it is very, very logical. I mean, it's a proper, healthy correction. I think the divergence between mid and small is too high. Let's see how the market does. Maybe mid will keep correcting and large will make a move, or large will make a move but mid will stay there, and then it will catch up. So market does its own stuff. I think most important thing is now, don't wait for because we are closer to the bottom. Now, whether it is 1,000 points away, 500 points, I have no idea. And let me tell you, nobody has any idea. Now this is a time, stocks are making bottoms. All the stocks will not make bottoms on the same day. Okay, so if you like certain stock, and that stock is available at your dreamy price, and it has gone below that, don't hesitate, start moving into the market.
Okay, welcome back. We've got the market down 6 points, absolutely flat actually. 22,100 is where we're at. Sanjay Parikh is with us, founder and CIO at Soham Asset Managers. Sanjay, good afternoon. Good to have you on the show as always. We played that soundbite of Ramdevji earlier. He was saying we're close to the bottom, 500,000 points. I don't know. And actually, you're starting to hear more and more of those voices. Samir Arora was on a few days back, I think about a week and a half back it was. And he was talking about close to the bottom again. I mean, a few percentage points, no one can tell. And I think those few percentage points have happened since we spoke with him. What is your sense, Sanjay? Time to... and of course, the question always is for mid and small caps, large caps. So just your view now. Sanjay, you'll have to unmute yourself, please.
Yeah, sorry. So, good afternoon. So, I agree with them. I mean, you take, I'm talking about Nifty now in terms of earnings yield versus debt yield, the gap which was higher, on FY26 now, we had an earnings yield of, let's say, 18.5 times on 26, which is 5.3% yield, 10 years at 6.7. So, we are at 1.3% gap, which is absolutely a reasonable level and an attractive level to buy in. You take on broadly, price earning, absolute price earning also now it's getting reasonable. As we move to 27, it gets further comfortable. So, and now we've also seen time correction. So, and the best part is now slowly and steadily we are seeing some recovery. So the PMI numbers that you've seen in some of the heat map indicators, a little bit of better credit growth. So I'm sure the government spend will have impact in February, March and ahead. And as slowly and steadily we recover, certainly, we strongly believe that for Nifty larger cap products, this is a time to buy in and one should not now try to get exactly at the bottom, it's always humbling, right? We were positive 3-4% ahead of the current market, but it is down 4% and that's a reality. So in the near term, what flows would do, we don't know. But fundamentally, our conviction from the time we've started our fund is the highest to buy into products which are large cap based,
Sanjay, so let's go with the thesis or assumption that, we're close to the bottom and markets will see a bit of a recovery, large cap. Now, there's one, there are some who believe that when we get this rebound, it'll suck more people in. And then there is another gut-wrenching correction, which, awaits us, which could take the Nifty even lower, maybe down to levels of about 19,000, 20,000. Do you think just over the medium term, near term, fine, there is a recovery. But do you think there could be another correction which awaits us?
No, I don't think so. So, again, the starting point are balance sheets. I've seen the banking sector for last 15 years. I've seen 10 years it took to clean up the NPAs, You take all the balance sheets, you take banking balance sheet, SBI and net NPA is the lowest. We can see inch up in overall NPAs, but it's not any major leg up. You see corporate balance sheet at the lowest leverage. Household balance sheet, of course, at the top end is good. In the mid end, is need to support them. At the lower end of 70, 80 crore people. And then, the gold, the wealth effect of gold is not discussed. But if you take the negative effect of equity versus the impact of positive wealth effect of gold, it actually neutralizes because Indians are full of gold across balance sheets, across the board. So that has helped. And, and even the fiscal deficit, we have an operating leverage there. We saw that slowly and steadily we will reduce our fiscal deficit. And RBI, you saw when the intention was to give back liquidity, durable liquidity through swaps or injecting VRR through VRRs or direct infusion, all of them has happened. So now you're able to see the intent also that RBI and government is wanting that economy should recover and supportive of growth. And this is exactly the combination where there is uncertainty, you have near-term pain, there is disbelief, and as things get better, markets can actually move up, and then it might be a little late for one to buy in. The only argument where I think is a relative valuation, where still emerging market is at very low valuations, China is also at low valuation, and we are still at 18.5 times. So there could be some more time correction as growth recovers, but we are very, very confident and comfortable to buy into Nifty-Nifty-based products from current levels.
All right. Hi, Sanjay. Good afternoon, and good to see you. But as you say, the market ultimately, the prices are the ultimate king. You all believe that the time is good, and both, you have the double engine that's firing. RBI is seeming more growth-oriented, and the government's measures as well will support growth earnings for the coming quarters. That said, two factors I wanted to get out of you. One is, what is your client behavior? Are they getting nervous? Are they willing to put out more money? You're sitting on around 5% of cash. That's point number one. And point number two is, in terms of sectors that are high beta, metals as well as real estate. And I'm looking at it, I think real estate is something that you like at current reckoning. The sector, the stocks have pulled back 20-30% as well. Your view on it. So tell us both. Client behavior as well as real estate theme. Go ahead.
Yeah, so clients, we have family offices, large HNIs. I mean, nobody likes wealth erosion to start with. But I think there's no panic. In fact, most of the queries we get is, should we deploy? What should be the pace of deployment? Our distributors are also very, very mature. So, we try to give our best view and even telling them that, you can certainly now not wait. You can deploy 50-60% and grow gradually for the rest, the next 2-3 months. But now there's no need to spread out big way because the levels are very good now. So that's on the client side. We don't see any panic there, especially in the HNI and super HNI and family offices. That's a fun thing. Second is, our cash level certainly is 5%. We will look to deploy. And our price earning, we're comfortable with the price earning of a portfolio today at 13 times, a little over 13 times on 26, with growth of 18-19% and ROE also of 17%. So our portfolio has a cyclical tilt, and we did see a near-term underperformance compared to Nifty TRI, which is our benchmark. But we were very, very confident, that even in some of the metal stocks that we own, real estate may take some more pain, but overall, we think there also, we own DLF, where we think the longer-term addressable opportunity is pretty large, and we would hold on to them. So that's where we are. So bottom up now, we are taking a view on larger caps that we like. For sure, some of them have become very, very attractive across financials, bank, transportation, and then telecom. And then middle and small cap, we will be very, very selective, and our margin of safety will be higher, which has always been the case.
Okay, got it. Sanjay, in terms of your list of overweight, so basically sectors that have a fair amount of representation already in your fund, banking and financial services for sure, IT, you also have a large amount of, I think, telecom in the portfolio, almost 6.5% or so. What about consumer? And there's capital goods as well. I saw that in the fact sheet. What about a sense on consumer? Would you be betting on any kind of, recovery in consumption, whether it's urban, whether it's rural? And would you look to play that through any way, directly through FMCG, or maybe indirectly as well, through other sort of consumption proxies?
Right. So, we have taken sector bets, and some of it is aggressive. So, our FMCG weight is 0 now for more than 1.5 years. or our oil and gas weight is 0. So we do take such bets. We are overweight on, as you said, capital goods, financials, overall financials. Telecom is a big bet that we've taken both through Indus and Bharti. And then, of course, capital goods also we have overweight through Larsen and Toubro and one or two mid-cap names. So we are continuing with the IT. We are underweight. It did hurt us in the mid last few months, but after this correction, we are okay. So, but over a 3-year period, you still see IT has underperformed. So we would want to continue to remain underweight there, and that would be our view right now to have this sector view and go bottom up on each of the stocks that we like.
Sanjay, thank you very much for that. Today, there is a Kotak upgrade on TCS as well as Tech Mahindra. On TCS, Kotak says that the stock has corrected 17% in the last 3 months, 22% in the last 6 months, and the stock is now available at 23 times forward multiple. And this valuation multiple is at levels that it was pre-COVID. So therefore, according to them, the stock is attractively valued. They've upgraded TCS to a buy. Target price, though, has been lowered to 4,100 because at least next year will be a year of below normal growth. For Tech Mahindra too, Kotak Institutional Equities has upgraded the stock to a buy. Their target price is 1,800 on Tech Mahindra. They say it's a turnaround play at palatable valuation. The stock is trading at 19 times FY27 earnings. And they do concur. I mean, the management has set a goal of getting margins to 15%. Remember, they have a new management. There is a turnaround underway. They've set a goal of 15% margins by FY27. And current margins, they're likely to end this year with about 9.5–10%. And according to Kotak Institutional Equities, the company will be able to achieve it. So Tech Mahindra and TCS getting an upgrade post the recent correction. Valuations are attractive. But moving on to BSE, that's under pressure, down 5%. Goldman Sachs has slashed the target price on regulatory concerns. Vamakshi joins in with the details.
Well, absolutely, Rima. We know when we look at Goldman Sachs, they maintained a neutral call on BSE. They've gone ahead and slashed the target price on BSE to 4,880 rupees. Keep in mind that SEBI had published a consultation paper in the last week of Feb to bring down the volatility in the derivatives market. Now, Goldman Sachs believes that this does not bode well for an exchange where option trading accounts for nearly half the top line. They have highlighted that industry volumes, both in the cash segment as well as the option segment, have been a bit softer as compared to forecasts for the month of February. In fact, specifically talking about BSE, they say that the cash average daily turnover share was also lower than what was expected. Given those factors, they believe that the industry volume cuts outweighed the higher option market share that BSE managed to achieve. And given that factor, they've gone ahead and cut their EPS estimates. They've cut the EPS estimates by 1% for FY25. It's a much higher cut for FY26 estimates because that also has been slashed down by almost 14%. It's 12% for FY27 and a nearly 11% EPS cut coming in for FY28. They've also highlighted that the share has corrected by almost 16% in the last couple of sessions. They believe that it is largely pricing in the risk of industry volumes from implementation of these proposed stricter norms from SEBI. But that said, they say that the final outcome remains highly uncertain, and the consultation paper that was published recently was not quite expected by the street. So overall, the note from Goldman Sachs sounds quite cautious on BSE, and resultantly they've gone ahead and cut their target price to 4,880. The stock as of now is under pressure.
All right, Vamakshi, thank you very much for that. 6% cut actually, so that's a sharp one. We'll take a quick commercial break here, but here's a quick note for our viewers. What does it take to move the needle on gender parity? The biggest names in business, policy and leadership come together at the Mega Summit for HSBC Presents CNBC-TV18 Future Female Forward, co-presented by Cognizant. To answer that question, tune in live on CNBC-TV18, 10th of March at 5:30 p.m. as we bring you insights from those shaping the future.
Welcome back. Well, the markets, the Nifty is as flat as can be. The good news is that the broader markets, the number of stocks advancing from around 250 stocks earlier this morning, it's now at around 800 stocks that are advancing. So at least the breadth of the market is looking relatively better than what we saw in the morning. But Nimesh is with us on D-Street Chatter. Nimesh, what are you picking up? I mean, the negative sentiment continues. People are, quite nervous about the markets. But at least from those oversold levels, we've seen a bit of a bounce.
Yeah, Nigel. So, clearly a good intraday recovery, not only in the Nifty, but in the broader markets. And I'm more enthused about the broader market recovery because, first time it was given that there will be selling from the margin guys. So that actually is been done. And after today's fall, the feedback is large part of that selling from the leverage guys seems to be done with. And, most of the retail investors, HNI investors in the last couple of days have thrown in their towels. They've been just, getting panicked and selling off. The difference is in the last couple of days, this was the feedback on Friday as well, that some smart guys have started nibbling to some extent in their individual names. So that's the first sign of some bit of confidence back from some larger investors. So that's the feedback from the retail part. As far as the institutional activity is concerned, I still believe that the FIs are net sellers. But today the feedback is maybe one of the large domestic fund has done a very large basket buying only because that fund was sitting on too much of cash. So it deployed some large amount of cash. Not only on Friday, but aggressively today in today's market as well. So maybe, one need to see the domestic data very, very closely today. So that's the other feedback. But, as I said, the bigger take for me is the fact that large part of the pain seems to be out in the broader markets. That's the feedback which one needs to monitor now. So at least, Nigel, in the first few initial days, you will see a bit of momentum in the Nifty. Only once the Nifty stabilizes to some extent, you will see a bit of pullback in the broader market names as well, because everything looks very oversold. So that's a broad view. Even from a sector point of view, a bit of nibbling seems to be happening in the PSU names as well. Not every PSU is bought, but there is a bit of nibbling happening in the PSU names. So broadly, I guess some bit of value is emerging, and that's where a lot of investors, especially the larger HNIs and all smart guys, seems to be nibbling in the last couple of days.
Well, that's right. Nimesh was doing a rough screener check, and in fact, I looked at Narayana Hrudayalaya. We're talking about the markets being down so much. That stock is at a fresh 52-week high and on very, very large volumes. So pick and choose. There are select stocks that are doing well, but you have got a list of stocks that you're tracking as well. Run us through the list.
Right. So in terms of individual names, the first stock on my list is Godrej Properties. The entire, real estate basket. On Friday, if you remember, on the chatter there was Lodha, which was seeing some buying interest, and now there is Godrej Properties. So again, small buy flows, but it's getting reflected on some bit of risk back in those momentum stocks in the real estate names. So Godrej Properties stands out for me in terms of buy flows. And also remember, for Godrej Properties, all eyes will be on the Maharashtra budget, which will come later this week. So that will have an impact on the lot of Mumbai-based real estate names, including Godrej Properties. So that's the first stock. The second stock is Voltas. Out of the blue, that stock is buzzing in trade, big volumes, and in the green since the morning trade, essentially because of buy flows. And also there is a Morgan Stanley tactical buy on the read-through from Blue Star's management's commentary. So looks like, at least the summer season will be quite strong for these AC players. The third couple of mid-cap names where HNI action has started. First is Dilip Buildcon. Today, the stock is up 4%, large volumes, and I understand some larger HNIs have bought. Similarly is the case with Indostar Capital. Well, the stock is down 4% today. The volumes are on the higher side, and I believe some smart HNIs have started accumulating Indostar at lower levels. So that's from the HNI activity point of view. And the last is Bharti Airtel. There were a lot of shorts in the system on Friday as well. But again, I understand there is a bit of buy flows from larger institutions today. So that stands out for me. Bharti Airtel, good flows. That's on the buy side.
Okay, all right. Nimesh, got it. Thank you very much for the update there. So lots of stocks and lots of buzz in the market. Though otherwise, of course, we have had a fairly choppy session. So just to go back quickly to look at some of the trading calls, final trading calls that you can consider. Last 15 odd minutes to go. We have Mitesh back with us. Mitesh, so what's the final advice at the index level and also individual stocks?
So again, I think nothing much happening on the index. So what is interesting me is possibly Siemens, I think, trying to recover from extremely oversold levels. BTST here with the stop at about 4,800 for targets of 4,890 for tomorrow. The other one is similarly, I think, another stock which has been extremely oversold is Solar Industries. BTST here with the stop at 8,950 for targets of 9,065.
Okay, Solar Industries in focus 89.85. Okay, all right. Mitesh, thanks very much for that. Now, Delhi Airport, owned and operated by GMR Airports, has proposed a higher UDF charge and justified the move by citing losses and debt piling up. Madhya is here to tell us about what this is all about, the background, and whether this is likely or not. This is, of course, sensitive for the listed entity, which is GMR Airports, up on your screen. Madhya, take it away.
Well, Prashant, user development fees charged by an airport operator to passengers to bridge the revenue shortfall. This fees varies across airports and the amount is approved by the Airports Economic Regulatory Authority, or AERA. Now, GMR Airports operates Delhi Airport, Hyderabad Airport, Goa, Nagpur and Bidar airports. It is also developing the Visakhapatnam International Airport. Now, when it comes to UDF, Delhi Airport stands among the lowest at a flat fee of 129 rupees for domestic and international passengers as compared to what airports like Bengaluru, Hyderabad, Chennai, Kolkata and Ahmedabad airports charge. Now, GMR took over Delhi Airport in 2006 and the tariff proposal that it has submitted now is the fourth control period from April 2024 to March 2029. Now, here DIAL has proposed UDF for departing as well as arriving passengers on peak hour and non-peak hour basis. So, for example, domestic passengers, the proposed fee is 405 rupees during off-peak hours and 610 rupees during peak hours. For international passengers, departing economy class will pay 810 rupees and business class will pay 1620 rupees. Now, please note that these rates are in proposal stage and the final tariff will be determined only by AERA. Now, DIL justified the demand citing insufficient cash flows and consecutive losses totaling 1795 crores from FY21 to FY24. They are projecting a 1794 crore rupees loss in FY25 as well. And with a debt of 14,786 crores and a declining credit rating, the airport told AERA that raising funds for future projects has become difficult. It claims to have invested 12,500 crore rupees from 2019 to 2024 in new developments like Terminal 1 development, 4th runway and Eastern Cross taxiway. The airport said that there is a significant need for capital expenditure to maintain and develop the airport's infrastructure, and that's why the hike proposal for UDF.
All right, Madhya, thank you very much for that. This is an important story. We will keep sort of tracking as we go along. Well, the DAM Capital and Jefferies have issued bullish calls on UltraTech, and we're going to talk about that with Nigel. Coal India, though, is going the other way. Morgan Stanley has called the decline in offtake a key negative for the stock. Nigel, take it away.
Well, that's right. You know, UltraTech had a con call on Friday evening, and we had mentioned earlier today that UltraTech could be the stock of the day, and because of their con call, it may not be only good for them, but it could be good for the entire industry. Here's what they had to say. First, the basic details. They look at an IRR of close to 25%, ROC of close to 20%. In terms of a mix, they're saying that wires will be 60% of their mix, cables could be around 40%. And otherwise, you know, more or less the details that we were working with, commissioning by December 2026, we knew that, and asset turn of close to around 5 times. The crucial takeaway is, though, and the reason that all the stocks are excited, both UltraTech as well as the cable and wires makers. One is they said this is one of strategic diversification. They're looking at getting a larger part of the client's wallet share. Point number one. Point number two is they clarified they're not looking at any other new business opportunities. So those that were arguing that why are they diverting away from cement? Well, they've got their answer that they're not looking at anything new. Third, they said they're not expecting any kind of pricing pressures, you know, for the industry, which will be a relief for the current incumbents. What did DAM Capital say? They reiterate their buy rating. They have the target price that comes up for you in the screen. They say that the recent stock price, it looks like an overreaction, the correction that we saw. The investment is very, very nominal. It's only around 2% of their gross block. And also there are various advantages in place. The ROCE, as we had highlighted earlier as well, they have mentioned in their note that the ROCE on this business is around 20%. On the core cement business is 12%. Jefferies, they have a buy rating as well, target price of around 13,265 odd. They got comfort from the management's commentary with regard to capital allocation. They also remain confident about the company being able to continue their leadership position. So put this together, the street likes it, and that's why the stock, after correcting close to around 8%, is up 2.5% today. And along with it, you have, you know, KEI, you have Polycab, Havells, all of them are trading with some green, because it's a relief for them. Coal India, why is it negative? Production was down by 1%, but dispatches are down by close to around 5%. Even year to date, very, very marginal growth, both on the production as well as on the offtake. So that guidance that they've given earlier, they're likely to fall short by that. Morgan Stanley, they have highlighted that they're overweight on the stock. However, the sharp moderation in the offtake is a negative. It's the factor that could impact their Q4 FY25 numbers as well as FY26. That explains why Coal India, after seeing a good run in the last few sessions because of that price hike, the stock is under pressure today.
Thank you very much for that. We will slip into a commercial break. As we do that, let's get you some more market perspective from our markets editor for the day, Ramdev Agrawal of Motilal Oswal Financial Services.
In 2-3 months' time, when promoters will actually come to buy, because they are the guys who are the smartest. They know the value of the company. So when the promoter starts buying, so actually you start seeing that selectively in the companies, promoters will start buying. And those are companies to track. It's a much bigger game. So, you know, the irrationality which was there, where because of lack of supply, the irrationality in terms of pushing the stock price of multiples to 70, 80, 100, irrespective, that was wrong. So that will correct. Even that is behind, I'm telling you. It will correct. What has to be corrected will get corrected. Capital market is as, you know, as the sentiments gets hurt in last 5-6 months, there is a decline, there are restrictive, say like from daily F&O, now you come to weekly expiry. So obviously there is a almost 30-40% decline in the overall F&O volume. So we got expanded too much. Between 21 and 24, we got expanded too much, and then regulator got scared and they said, we want to contain it. And that's what they did. And effect of that is visible. I mean, Nitin of course knows the books. You know, so that's what is happening in broking. That's what is happening in slowdown in now. AMC flow was very good till last month. This month, I think there is somewhat, it is slower.
Welcome back. Well, the markets are more or less flattish, but as we have been saying, good recovery is what we've seen in the broader markets, post the morning downtick that we did see. Just 7 minutes to go. Let's welcome our guest, Sudeep Bandyopadhyay, joins us on the show. Hi, Sudeep. The broader markets have recovered. You know, a lot of stocks are now at the high point of the day. We have Tube Investments, Atul Limited, both of them moving well. Polycab as well as another name that spiked up. Sudeep, I'm throwing it open to you. Which is that one stock you believe has corrected enough, it has growth, and you believe it's available at the right valuations? Give us one pick.
Well, I think if I had to pick up one stock in all this, in between all this mayhem, it would be State Bank of India. I think, it's a asset quality wise, they are probably at the best space as things stand today in probably a decade. All the subsidiaries are doing well. Interest rates in the economy are coming down. Loan growth is decent. So I think overall, and the correction has been brutal. So I think considering everything, if I have to pick one stock and, with a conservative outlook, I will go for SBI. I just want to mention one more thing, Nigel. I think UltraTech, I have been mentioning for quite some time, and I will maintain, does look very good. Their foray into cables and wire segment also is very, very interesting. It will be eventually do wonders for the overall UltraTech business.
Okay, that's the thought on UltraTech. Let's actually put the spotlight on the pharma space. Today we had an extensive conversation with Ramesh Swaminathan, Executive Director and Global CFO and Head of Corporate Affairs at Lupin. And the discussion was really around what happens now if we have this whole reciprocal tariff business coming into action between India and the US. Then what could this mean for Indian pharma companies that have historically been big exporters of pharma products into the US? Now, Mr. Swaminathan says there's not much to worry about at the moment. Listen in.
The cost of manufacturing in America is not going to be cheap. I know as a matter of experience that what costs about $6, $5 per 1,000 tablets could potentially cost about $35 to $40 out there, 8x in terms of manufacturing cost, conversion cost. And that's something which has to be, it's not easy for them to kind of digest something like that. This industry, it caters to the rest of the world as well. And America is not necessarily the El Dorado that it was some time ago. So a lot of companies are kind of diversified also. So from a sector perspective, whilst it is, of course, disturbing news, it's something that we need to contend with. These temporary blips will certainly continue, but I see a long-term future which is pretty, pretty rosy and pretty interesting, alluring from a pharma perspective. it's not as though we are dependent only on America. So essentially, from our perspective and from the industry perspective, India is still a wonderful market, and there are exports to other parts of the globe as well. Though, of course, America remains the most important market, and any tariff change will certainly in some ways impact it. The cost of manufacture in America is multifold in terms of cost vis-a-vis an Indian scenario. And from that perspective, manufacturing in America for the long term does not really make sense. From our perspective, I would say, we export close to $1 billion from India, and what we actually manufacture in America is perhaps about 8 to 9% of that.
Okay, all right. With that, when we have just about 4 minutes to go, Sudeep, just a very quick call. Does that explanation hold water with you that right now there's no reason to start, selling off your pharma stocks? What Mr. Swaminathan just said. What's your take on Big Pharma here in India?
Well, I will not probably sell pharma, but I think I need to be a little cautious. And that's what I will advise investors also. If I have to pick up pharma stocks, and I think I made it very clear, I will only look at domestic focused pharma companies. Mankind is a typical example with 95% business in India. And if I have to look at companies having a business in US, I will look at companies which have significant manufacturing base in US. And Piramal Pharma is one example there. I think I like both these stocks, and I would stick with these.
Sudeep, what about Reliance Industries? That's fallen below its 200 weekly moving average for the first time since COVID. It's a very rare event that something like this happens, breaching important support levels. Steep correction. What are you doing with Reliance Industries now?
Well, I've been positive, and I've been recommending buying Reliance for quite some time. I think I've mentioned this on the channel as well multiple times. I think it's a great opportunity of buying and accumulating Reliance stock at this stage. There will be significant value appreciation from current levels. Of course, there is a great possibility of value unlocking as well going forward when the telecom business moves out in some form or the other, retail business moves out in some form or the other, and maybe the green energy business also moves out in some form or the other. But beyond all that, value unlocking, I think fundamentally the stock needs to be valued at a much higher level compared to where it is. So I look at about 1,500 kind of a price level, when markets start stabilizing and starts looking at the undervaluation of Reliance closely.
Sudeep, two other sets, right? REC, PFC, any thoughts? And then if you want to come in on these hospital names, Narayana is up sharply and Medanta is coming back up as well.
Well, I've been positive on this entire power sector, Prashant, and I believe that the entire power ecosystem is in for a good time going forward. Yes, the valuations have come down sharply with this correction of the market. But overall, every participant in the power ecosystem will benefit going forward. Now, the power financiers have a special opportunity. The power plants which need to come out, incremental generation capacity which needs to come, needs to be financed. And that cannot be financed by the banks because that's not their core business. So the opportunity in front of the power finance companies is significant. So whether it's PFC, REC, or even IREDA, I think the opportunity is great. Also, I must say the asset quality also has improved significantly. So definitely good buy at current levels. There are some positive brokerage reports also now, but I've been recommending for quite some time.
All right. Sudeep, thank you very much for that. For now, we're just going to come back to you on markets forward in a bit. A flat kind of close today on the indices. But I have to say that although advanced decline was still pretty negative, you'd struggle to find stocks which were down on large volumes today. So you'd probably pick an Angel One, an IGIL, Kirloskar Brothers, E-Clerks, maybe a Hudson. I'm talking about well-known names. I mean, otherwise there's enough on the downside, but very, very small names and no volumes. Volumes are all on what was higher today. And I think that is good to see. So the hospital companies, we were talking about Narayana and Medanta, REC and PFC, the AC companies, Blue Star and Voltas were up today. Varun Beverages, again, I think you can throw them along in with the sort of summer products category. Tube Investments, Siemens, there was Prestige which was up, Supreme Industries was up sharply, and Religare was up about 5% as well. And that's not the full list. There are more names which had volume. So I think for the first time in many days, the volumes on the downside kind of dried up, at least in terms of well-tracked, well-owned names. And I think maybe that's just the first signal, the first sign that maybe there is a bit of selling exhaustion in the broader space as well. But at this point, I mean, there's just hope. Fingers crossed. We'll have to see what happens. Rima.
Well, it's a flat close, but tomorrow is going to be an important trading session because China's much anticipated annual 2 sessions meet begins tomorrow, and then tariffs on Mexico, Canada and China are scheduled to take effect from Tuesday. So tomorrow's trading session will be crucial. We'll wrap up on Closing Bell. Don't go anywhere because on the other side is Markets Forward.